Hello and welcome. This is Helaluddin Ahmed. Today I am going to discuss on financial reporting and analysis. The objective of financial reporting is to provide financial information about the reporting entity that is useful to present and potential equity investors, lenders, and other creditors in making decisions in their capacity as capital providers. To be decision useful, financial information must be useful in assessing cash flow, prospects, and stewardship. Because of the estimates and judgment that go into preparing financial information, such information must exhibit the qualitative characteristics of relevance and faithful representation. To be relevant, information must have predictive value, confirmative value, or both. To be faithful, financial information must be complete, neutral, and free from material error. Complementing the quality of information are the qualities of comparability, verifiability, timeliness, and understandability. It is also important for users to understand the constraints on financial information or accounting convention used to prepare financial statements. Because accountants' measurements are not exact, certain conventions are applied to help users interpret financial statements. Consistency requires the use of the same accounting procedures from period to period and enhances the comparability of financial statements. Full disclosure means including all relevant information in the financial statements. The materiality convention has to do with determining the relative importance of an item. Conservatism entails using the procedure that is least likely to overstate assets and income. The cost-benefit convention holds that the benefits to be gained from providing accounting information should be greater than the cost of providing it. There are three basic components in a classified balance sheet. These are the assets, liabilities, and owner's equity. Under the assets, there are current assets, investment, property, plant, and equipment, and sometimes intangible assets. On the other hand, the current liabilities and long-term liabilities are the common examples of liabilities, and the owner's capital can be referred to the owner's equity. The current assets are cash and other assets that a firm can reasonably expect to convert to cash or use up during the next year or the normal operating cycle, whichever is longer. Investments are assets, usually long-term, that are not used in the normal operation of a business. Property, plant, and equipment are tangible long-term assets used in day-to-day operations. Intangible assets are long-term assets with no physical substance whose value stems from the rights or privileges they extend to owners. On the other hand, the current liabilities is an obligation due to be paid or performed during the next year or the normal operating cycle, whichever is longer. Long-term liabilities are debts that fall due more than 1 year in the future or beyond the normal operating cycle. The equity section of a sole proprietorship balance sheet differs from the equity section of a partnership's or corporation's balance sheet in that it does not have subcategories for contributed capital, that is the asset invested by stockholders, and retained earnings, that is stockholders' claim to assets earned from operations and reinvestment in operations. Now let's talk about multi-step and single-step classified income statements. The classified income statements for external reporting can be in multi-step or single-step form. The multi-step form arrives at net income through a series of steps. The single-step form arrives at in a single step. A multi-step income statement usually has a separate section for other revenues and expenses. In evaluating a company's liquidity and profitability, investors, that is owners and creditors, rely on the data provided in classified financial statements. Two measures of liquidity are working capital and the current ratio. Five measures of profitability are profit margin, asset turnover, return on assets, debt to equity ratio, and return on equity. Industry average are useful in interpreting these ratios. And that's all for now. Thank you.